I told you that we'll continue from where we stopped 2 weeks ago on CVP analysis. But before we proceed to today's class, I'm going to give you a quick recap of what we discussed in the last class. And by now, I expect that you should know the meaning of CVP analysis, the application of CVP analysis, and the different techniques that we use CVP analysis for, then the formulas for solving CVP questions. What is CVP analysis? I'm going to repeat a little bit of what I said in the last class so that those who were not opportune to attend will understand what we discussed. I mentioned that CVP analysis consists of three variables. Number one is cost, second is volume, and third is profit. And as the name implies, it explains the relationship that exists among these three variables. According to Wilkentin, it is a method of accounting, cost accounting rather, that examines how varying levels of cost and volume affect operating profit. It is also known as break-even analysis. This therefore implies that it has to do with break-even points for different sales volume and cost structure. So CVP analysis has to do with how variation in cost and sales volume affect profit. And it is a very useful tool for managers who make short-term economic decisions. Then I gave you another definition by CIMA, and they define CVP analysis as the effect of fixed cost, variable cost, sales price, quantity, and sales mix on future profit. And then I recommended the textbook written by Professor Ashaolu and Professor Nasser on financial management. Also, we talked about application of CVP analysis. And I told you that CVP analysis can be used for budgeting. We all know that budgeting has to do with the estimation of cost and expenditure of an organization. And when it comes to taking this decision, management often use CVP analysis because most times it has to do with short-term decision making. Also, management use it to ascertain product pricing and sales volume decision. Whenever they want to determine the price to fix for a particular product, they use CVP analysis as they tend to analyze the price of a particular commodity along its cost and the tendency that it's going to sell and the eventual profit or estimated profit that they are expecting from such product. Then it is also used to determine optimum production and sales mix. Lastly, I told you that it can be used to determine the effects of capacity utilization on cost. We also discussed formulas for solving CVP questions, of which I talked about break-even point in unit, which is fixed cost over contribution per unit. Fixed cost divided by contribution per unit. Then we also have break-even point in sales. Break-even point in sales is fixed cost divided by contribution per sales. Third is contribution contribution to sales ratio. Contribution to sales ratio is calculated by dividing contribution with sales unit. You divide contribution by your sales unit multiplied by 100. The fourth one, which is the level of sales to result in target in unit, is fixed cost multiplied by targeted profit divided by contribution per unit. Lastly is margin of safety. Margin of safety is budgeted sales minus BEP, that's break-even point in sales, divided by budgeted sales multiplied by 100/1. So I want to implore you all to download the material I uploaded to the Google platform. This will give you a guide on this. So today we are going to be discussing CVP analysis for decision making. As you know that CVP estimates how much changes in a company's cost, sales volume, and price affect a company's profit. Like I told you earlier, that costs are divided into fixed and variable cost. So before you can solve any question in CVP analysis, you first have to separate the fixed element of a cost from its variable element. So that's the first step before you can arrive at your contribution. And CVP is a very powerful tool in managerial finance and accounting, and it is most widely used in managerial accounting to help managers to make better decisions. From the foregoing, we can therefore infer that CVP is a management tool that could be used in making vital decisions when firms are faced with problems revolving around cost, volume, and profit. So that takes us to make or buy decision. We are going to be looking at make or buy decision today. There are times that management of a firm will have to weigh their option when it comes to a particular product. They will have to think of whether to buy that product or to produce it in-house. So I'm going to be giving you an illustration to demonstrate that to you. Make or buy decision, before we go into the illustration, make or buy decision is an act of choosing between manufacturing a product in-house or purchasing it from external supplier. I come again. Make or buy decision is an act of choosing between manufacturing a product in-house or purchasing the same product from an external supplier. It is also known as outsourcing decision. This decision is a process whereby management compares the cost and benefits associated with producing a particular good or service internally, or the benefits involved in hiring an outside supplier for this particular resource or product in question. And in order to do this accurately, management needs to compare cost across all cost implications. Cost regarding acquisition, storage has to be incorporated, because it is not just about purchasing this product. They will also have to think about the storage, the cost of acquiring it, and the storage facility that will be used for such products. So now we go to the illustration. Adefolaju Nigeria Limited needs a component in an assembly operation. Adefolaju Nigeria Limited needs a component in an assembly operation. If Adefolaju wants to do the manufacturing itself, it will need to buy a machine for 4 million naira, which would last a period of 4 years. This machine will last for a period of 4 years with no salvage value. The manufacturing cost in each of these 4 years would be 1. For the first year, 6 million naira. First year, 6 million naira. Second year, 7 million naira. Third year, 8 million naira. And the fourth year is 10 million naira. Alternatively, if Adefolaju had to buy the components from a supplier, the component will cost the following. For the first year, it will cost 9 million naira. Second year, 10 million naira. First year, 9 million naira. Second year, 10 million naira. Then the third year, 11 million naira. Then the fourth year, it will cost 14 million naira. However, the machine would occupy floor space, which could have been used for another machine. This latter machine could be hired at no cost to manufacture an item. What this implies is that this latter cost does not have any opportunity cost attached to it. Then I proceed. The sale of which would produce net cash flows in each of the 4 years of 2 million naira. If you look at this critically, this is the opportunity cost that Adefolaju Nigeria Limited is going to suffer if it decides to produce this machine internally. It is impossible to find room for both machines, and there are no other external effects. The cost of capital is 10%, and the present value factor for each of the 4 years are stated below. Year 1, we have 0.909. And before I proceed to that, I hope we all know that present value is the current value of a future sum of money or stream of cash flows giving a specified rate of return. So it is this rate now, when we use it to multiply the cost of acquiring the component, that will give us our future specified rate of return. So for the first year, we have 0.909. For the second year, we have 0.826. First year, 0.909. Second year, 0.826. The third year, we have 0.751. Lastly, for the fourth year is 0.683. Then you are required to find out through quantitative analysis if the firm should make the components or buy it from outside. I told you earlier that make or buy decision is a decision taken by the management, and this usually happen at the strategic management level. And the management cannot just decide whether to make a product in-house or to buy from an outside supplier without quantitative analysis. So such quantitative analysis is what we are going to do in this example. Now, we are going to evaluate the make or buy proposal of the company. And looking at it, we have the year ranging from 0 to 4. And why is the table starting from year 0? Because that's the year the component is being acquired. That's the year Adefolaju acquired the component. Now, the first thing to do now is to enter the present value for calculating the component future value. The first one is 1 because at year 1, the PVP, the present value is 1. Then the next one is 0.909. This is from the question I displayed earlier. From the PV values that I gave you, for the third year, we have 0.826. For the second year, rather, we have 0.826. Then for the third year, 0.751. The third year is 0.751. Then the fourth is 0.683. So with this, our PV table is complete, starting from year 0 to year 4. Then the next thing to do here is to enter the figures, the amount for the cash flow. And for the first year, the cost of purchasing the component is 4 million naira. And that is what we come in here. Adefolaju purchased the component at the rate of 4 million naira. Then the second year, we have 6 million naira. That's the cost of manufacturing that Adefolaju is going to incur in the first year. But then I want to remind you of the opportunity cost of 2 million naira that we talked about earlier. Because in considering the future returns and cost implication of this product, we also have to think about the opportunity cost forgone. So in view of this, we are going to add 2 million because it was stated that the cost for each year is 2 million naira. So in that regard, we added 2 million to 6 million, which is the cost of producing the component for year 1. The cost of producing the component in year 2 is 7 million naira. And we're also going to add the opportunity cost again, because this is the opportunity cost forgone. Next is 8 million naira. So we also had 2 million naira. Opportunity cost of 2 million naira will be added to 8. Then the next is 10 million naira. And we also had 2 million naira opportunity cost. So next now is to determine the present value of cash outflows. The present value of cash outflows. In order to determine that, we will multiply our present value factor, which is PVF, by the cash flow that we arrived at by adding our capital cost plus our manufacturing cost and the opportunity cost. So 4 multiplied by 1 will give us 4.000. Next is 0.909 multiplied by 8. So how did we arrive at 8? We arrived at 8 by adding 6 plus 2. So 6 plus 2 will give us 8 million multiplied by 0.909, and this will give us 7.272. Next is, okay, let me do it this way to simplify it. This is 8. The next one is 9. This gives us 10. While the next one, 10 plus 2 gives us 12. Okay. So 0.826 multiplied by 9. 0.826 multiplied by 9 will give us 7.4. 7.434. That's what it will give us. Next is 0.571 multiplied by 10. 0.5751 multiplied by 10. Then to give us 7.510. 7.510. Next is 12 multiplied by 0.863, and that gives us 8.196. That gives us 8.196. Next, we are going to look at the cash outflow. That's the cost of purchasing the components. That means if Adefolaju Nigeria Limited decides to purchase the components, this is the cost it is going to incur in purchasing the components. The values I'm going to input here are already in the question. So for the first year, since Adefolaju is not buying any machine, we omit the first column, the first row. Next, we have 10, which is 10 million for the second year. For third year, we have 11 million. And for the fourth year, we have 14 million. So to know the present value, based on the present value PV factor at 10%, of course, we are going to omit this place because we don't have any value for that year. So the next one is 9 million multiplied by 7 multiplied by 0.909 will give us 8.181. For the second year, we have 10 million multiplied by 0.826, and that gives us 8.260. The next one, which is 8.261, the next one, which is 11 multiplied by 0.751. 11 multiplied by 0.751 will give us 8.261. Lastly, for the fourth year, we have the cost of 14 million. So to arrive at the PV for the fourth year, we multiply 14 by 0.683, and that gives us 9.562. That gives us 9.562. So with that, we have been able to determine the PV for the products for 4 years. We have been able to determine the present value when we are buying the components or when we choose to manufacture the components. So the next thing is to add the PV for manufacturing the components, which is 4 plus 7.27 plus 7.434 plus 7.510 plus 8.196. Let me repeat that again. We will add 4 plus 7.272 plus 7.434 plus 7.510 plus 8.196, and this will give us the present value of cash outflow if Adefolaju decides to manufacture the product. And when all these figures are added together, it will give us 34.412. It gives 34.412. And for the alternative option of buying the components, we have 8.181. That's the PV for the first year. The PV for the second year, 8.620. If you add it to 8.261 and 9.562, if we add the four together, it will give us 34.264. It will give us 34.264. So now the next thing now is to compare the two. We are going to compare the two costs. 34.412 minus 34.264 will give us the difference of 0.146. So this tells us that the cost of manufacturing the product is higher compared to the cost of buying it. The cost of manufacturing is higher compared to the cost of purchasing the same components. So it will therefore be beneficial, since Adefolaju will be saving 0.146 by purchasing the components from an outside supplier. It will be beneficial to buy the components from outside. Given this difference, I repeat, it will be better for Adefolaju Nigeria Limited to buy the products from an outside supplier. So with this quantitative analysis, management can decide whether to buy or to produce a product. So management cannot just decide whether to make or to buy a product without going through the quantitative method. Now that we have calculated the cost implication, given the difference, we can now conclude that it would be beneficial or it would be better for Adefolaju to purchase these products outside. So next class, we'll be talking about transfer pricing. Transfer pricing, that's what we're going to be discussing in our next class. So with that, we come to the end of this class.